welcome back to another edition of the Prepper Recon Podcast. Our mission is to bring you great interviews with preppers from around the world so you can be better informed and better prepared for everything from a hurricane to the end of the world as we know it. This episode is brought to you by CampingSurvival.com. Whether your plan is to bug out or bug in, CampingSurvival.com has all of your preparedness needs, including bug-out bags, long-term storage food, water filters, gas masks, and first aid kits. Check them out online today at CampingSurvival.com. Be sure to enter coupon code PrepperRecon for a 5% discount on your entire order. Today's guest is John Rubino from DollarCollapse.com. John, thanks for coming on the show today.
Oh, sure, Mark. Thanks for having me on.
Oh, absolutely. It's our pleasure. What are the major economic threats that inspired you to start DollarCollapse.com?
Well, I set up DollarCollapse.com back in 2004, and even then it looked like we were accumulating so much debt and just, leveraging the global financial system to such an extent that the system was guaranteed to spin out of control based on both history and common sense. And I expected at the time to have maybe a 1-year gig running that website because I thought the system was so close to catastrophic failure that it wouldn't take long. And instead, we're still here. We had a near-death experience in 2008 and 2009, which we have survived thanks to printing huge amounts of new currency all around the world. And so I think the threats that were visible in 2004 have all been magnified since then. We owe more money than we did, and the things that we don't call debt but really are debt, like derivatives and unfunded liabilities of Social Security and Medicare, are vastly bigger than they were before. So, the average family in the U.S., if you add it all up, owes $2 million right now. And that's obviously unsustainable. It's obviously leading us off of a cliff of some sort. And so I think in the next few years, one way or another, we fall off that cliff and we have some kind of a catastrophic financial crisis. And the exact form of it is unpredictable, but I think that it's going to happen is really baked in the cake at this point.
Can you give us a brief synopsis of your book, The Collapse of the Dollar and How to Profit from It?
Yeah, that's co-written with James Turk, who runs Gold Money, which is a digital gold currency and gold storage service based in the UK. And the premise is that fiat currencies always die. Every currency that's ever been created that wasn't backed by something tangible, eventually the government that owns that currency runs wild because there's no limit on what it can spend and what it can borrow, and it eventually destroys the currency. And the U.S. dollar, as the world's reserve currency, is further along than most people understand in this process. And we're rapidly creating the conditions in which past fiat currencies were just inflated out of existence. And so something like that is virtually guaranteed to come to the U.S. at some point when the dollar just starts falling in value and there's nothing that anybody can really do about it. And we get a typical Weimar Germany or revolutionary France or yada yada. It goes on and on, a kind of situation where, as dozens of other countries have done in the past, we destroy the value of our currency. And so it was really an investment book, though, because what I just told you is basically the premise to an investment play, which is to invest in non-dollar denominated assets, things like precious metals, which are forms of money that governments can't create in infinite quantities and therefore will go up in dollar terms when the dollar starts going down, and hard assets like oil and farmland and foreign real estate and short positions against financial companies that'll be crushed in a financial crisis. So the book was set up to be a fairly comprehensive roadmap for people to change their financial structure in order to take advantage of the currency crisis that we saw coming. And it worked. If in 2004, 2005 you'd started doing all that stuff, accumulating gold, getting out of dollars, things like that, you would have made money for the next 8 years. And now we've kind of created the same conditions over again. James Turk and I are writing another book. It's going to be kind of a follow-up to the Dollar Collapse book. Only it's going to take into account all the things we've done since then to make things even worse. And so hopefully we'll have that ready by Christmas.
Oh, very cool. We'll have to get you back on the show so you can tell us all about it when it's
Great.
ready to go.
Okay.
Now, speaking of precious metals, I guess the big news today was the $40 an ounce gold sell-off. What do you think sparked today's sell-off? Is that the market pricing in a taper?
Well, with gold, there's no real way to know what causes stuff like this because it's a manipulated market, first of all. The central banks of the world and the big money center banks that work for the central banks tend to intervene in precious metals pretty frequently to make it really difficult to speculate on the long side and just generally moderate the increases because gold is a form of money that competes with the dollar and the euro and the yen. So when gold goes up, it makes the Fed and the European Central Bank and the Bank of Japan look bad. And since fiat currencies are based completely on perception, they don't have any physical reality, so they're only valuable if we trust the guys issuing them. So they don't like to look bad, and so they will intervene in the gold market to keep gold from making them look bad, at least while they can. They're running out of ammunition for that, but in the meantime, they can do it. So today could have been a manipulated move, or, like you said, it could have been a response to the perception that the market might change in the near future because the Fed is going to stop buying so many government bonds and stop pumping so much liquidity into the market. That's possible too. And also, after the really big sell-off that happened in July and August, gold had a nice comeback. It had gone from, I think 11 and change up to 1,400 and change. And so a correction of $100 or so is completely to be expected in that kind of a move, assuming it's going to keep going. If we're back in a gold bull market, which we could be, I think, then $100 down moves are completely to be expected, completely par for the course, and nothing to worry about.
Sure. And then for people that think that gold market manipulation is conspiracy theory, tinfoil hat stuff, the London Gold Pool was doing this stuff openly back in the 60s or the 70s?
Mm-hmm. Yes. And see, if you think of gold as a form of money, then governments intervening in that market isn't an outrageous idea at all. We intervene in the currency markets all the time. We manage the dollar versus the yen versus the euro, and we do it openly or we do it secretly, and nobody really thinks much of it. And so that we do it in the gold market is not that big of an intuitive leap, and it's not really an outrageous conspiracy. It's something that seems probably completely natural for the guys doing it, except that they do it secretly. And because they do it secretly, it constitutes fraud against people who honestly invest in precious metals, and the companies that mine precious metals and would get a higher price if it wasn't manipulated, and the countries that have big gold mining sectors that would be getting a lot of tax revenue in and more jobs and things like that if the price was where the market would take it. So I don't want to minimize the amount of evil that's at work here, but I also, I don't want to make it seem like it's some really radical, out of left field kind of idea either. It's something that governments do in the normal course of business. And in this case, they just happen to be doing it secretly. So, it's one of those things they'll get away with it until they can't anymore. And I think the interesting story is the imbalances that are building up that make it unlikely that they're going to be able to continue to manipulate this market for much longer.
Yeah, and then I guess today's route, though, we did see that it was during normal trading hours as opposed to a lot of times when it's very obvious because it's at 2 o'clock in the morning and Sunday night.
I know. Yeah, that is usually the way they do it. They'll come in at 2 o'clock in the morning when there's nobody else in the market, and they'll dump some massive number of futures contracts on a really thin market and just make the thing move in a big gap down. And they didn't do that this time. They just to the extent they did anything, they did it in the light of day in a normal market, and gold went down hard. But again, it could just be a normal market move too. Gold is a thin market. It's really not that big. There's not that much gold traded. And it's highly susceptible to one big player coming in and wanting to adjust his position or something. And so I don't think we should read very much into any one day's move.
Right. And 2004 was when your first edition of the book came out with James Turk. And in that book, you had advised folks to purchase gold and silver. I think at that time, the price was below $400.
Yes.
So, people that followed your advice back in 2004 did really, really well. Even with the recent pullback.
Oh yeah. I mean, gold was the best performing asset for the next 8 years. Better than everything else. And it went up an average of 12% a year from that day forward. So it was a really nice call.
Yeah, it really was. It really was.
Yeah. So, now the question is it over for precious metals, or is this a breather in a longer term bull market that's going to go to, multiples of today's price? And, that remains to be seen, but I think it's probably, true. I think that's probably the kind of situation that we're in, because the conditions that in 2004 pointed towards higher precious metals prices and, conversely lower currency values are not just still in place, but they're a lot more extreme than they were back then. You know, we are borrowing more money than ever before at every level of society, and we're taking on more and more risk. Leverage is growing, exponentially. And we aren't fixing any of the underlying problems. Government spending is still growing at a dramatic rate, and new currency creation is happening, and government is taking on more debt, and now it's convinced the private sector to start borrowing again. So, and the big banks are still leveraging themselves to the hilt and playing games in derivatives, which now constitute an almost quadrillion-dollar market with absolutely no regulation whatsoever. So, we've created the conditions for some kind of really catastrophic failure in the global financial system led by the U.S. So what seemed like a done deal in 2004 is now a doubly done deal today. You know, there just seems to be no way out of it, because there is no way to raise taxes enough to balance our budget under these circumstances, or to print enough currency to keep us growing without causing massive asset bubbles that destabilize the system. There's no way out when you borrow too much money for a country as well as for a family or an individual. You know, if you and I borrowed $10 million on our credit cards this week, our lives would be a mess going forward, and there would be no way out of it. And that's kind of what the U.S. government has done. We've just borrowed more than we can ever hope to pay off, and now we have to suffer the consequences.
And how do you value gold? What's the valuation method that you use for that?
Well, there are two ways to look at gold. And one is to think of it as a form of money that eventually is going to back the paper money in the financial system once again. So then you just value gold based on how much paper has been created over the last 30 or 40 years. And if you do that, if you take the price of gold that would be necessary to balance out the paper currency that exists, you get like $5,000 to $8,000 an ounce. And that's a probable, reasonable target based on history, because we tend to go that way. You know, we tend to end up with gold being able to finally back the currencies in the world at the end of a big financial crisis when things have gone far out of whack like they have now. And the other way is to think of gold as a potential bubble asset, where once things really get going, people are going to realize that paper doesn't work. They're going to lose faith in fiat currency as a concept, and want to convert all of their fiat currency, all of their dollars and euros and yen, into real tangible assets at whatever price. And if that happens, then they bid gold into the stratosphere. You know, we could see $10,000 an ounce or more. And then that's a speculation. You know, if gold goes to $5,000 an ounce and you hold on hoping for 10,000, you're gambling at that point. You know, it's like buying tech stocks in 2008. It might work. You know, you might triple your money from there, but you are betting on people being even dumber than you. You know, the greater fool theory, that you can sell out to somebody who's even more excited and more credulous than you happen to be for holding on to gold when it's going beyond its intrinsic value. And I wouldn't argue against that with some of your money when that happens, because I think there's a very good chance we see a real mania at some point when fiat currencies start to crater. But the logical investment money is going to be made between now and $5,000 an ounce.
And then at $5,000, what do you buy? Farmland?
$5,000. If you've got a lot of gold today and it goes to $5,000, you can pretty much buy anything you want to. You know, it might at that point be time to go back into fiat currency-based assets. You know, maybe time to buy bonds, because bond yields will be very high at that point. Sure. In the 1970s, which was not a financial crisis on the scale of what's coming, bond yields hit well into double digits. You could buy long-term treasury bonds yielding 15, 16, 17% back then. And they were phenomenal investments for the next 30 or 40 years. So the same thing might be true at some point. And at that point, it becomes an analytical challenge. When would you get back into these paper currencies? And I think the point will be when serious governments start talking about backing their currencies with gold. When we go back to some kind of a sound money system, then you want to own those monies. You want to own the currencies that are backed by gold and be involved in financial assets again, because that's where the growth prospects are. But, that's a long way from here. We still have this crisis to get through first. And so we don't want to get too far ahead of ourselves. Right now, you've got a lot of analytical and intellectual challenges, just trying to figure out how to invest for what is going to look like chaos when we're going through it.
And the current gold to silver ratio is 61 to 1. Is that a sustainable ratio? If not, what do you think the proper gold and silver ratio should be?
Well, historically, it's been 15 to 1, where gold was 15 times as valuable as silver. And right now, about 10 times as much silver as gold is taken out of the ground every year. So a logical ratio for those metals would be somewhere in that range, because that's historically and physically measurable. And that they've gotten this far out of whack means that probably silver has more upside than gold going forward, assuming that we don't drop into some kind of industrial depression, in which case gold would do well as cash and silver might suffer as an industrial commodity where demand goes down for it. But in the kind of Austrian economics crack-up boom where people lose faith in currencies and nobody wants to hold them, silver should do a lot better than gold. So I think that at today's prices, there's no guarantee what happens in the next 6 months. Silver might go down to $15 from where it is today in 21 and change. But I think over the next 5 years, it wouldn't be a surprise to see silver up over $100 when things really get going. So I think from here to there, silver is a great investment.
And do you know offhand what the average production cost is for an ounce of silver?
Oh, it's really high. It's pretty close to today's silver price, which means that the average silver mine is not making any money, and the higher cost silver mines are looking at shutting down if they haven't already. And that means that the supply of silver going forward is going to be constrained, which is another good sign for physical silver that's already out there. If you already own silver coins or you're thinking of buying them today, then the fact that a bunch of mines closed down is good news for you. Because the supply is going to be limited going forward.
And the Indian rupees dropped almost 20% since May. Is this something Americans should be concerned about?
Yeah, the developing world, you have to feel sorry for them, first of all, because they are really at the mercy of the developed country central banks. When the Fed or the ECB or the Bank of Japan prints a huge amount of new currency in order to paper over our domestic mismanagement, a lot of that money flows into these smaller countries and really destabilizes them. It flows into India or Thailand or Brazil, and it bids up their stock prices and their farmland prices, and their food gets really expensive, and their people can't afford to eat, and their currency gets too strong, and their exporters can't export anymore because their products are priced out of global markets. And then, if that's not bad enough, we change our policy here, and all that hot money flows back out again, and it crashes their asset prices and their currencies tank. And, it has nothing to do with their management of their own economies. It's just them being whipsawed by their environment. And India is not a well-run country, but their big immediate problem is that hot money is flowing back out now after flowing in for years and years. And so it's causing their currency to really crater. And that's destabilizing a lot of different parts of their society. So it's not their fault, but it is exposing a lot of structural problems that they let fester during good times. And so India and a lot of the rest of the developing world isn't as bright a prospect as it looked like it was 2 years ago when the hot money was flowing in. And so now they've really got to deal with their structural stuff on their own. You know, they've got to fix their own problems and also figure out a way to moderate the hot money flows later. You know, all of a sudden, see, the world used to be wedded to the idea of free capital flows. That was the big trend since World War II. We've been getting freer and freer and dismantling capital controls and other things that impeded the flow of capital. And now we're swinging back in the other direction where, countries are starting to think, listen, this hot money is not a good thing. We don't want to invite the whole world to invest in us and then pull all their investments out. So we're going to put barriers to entry up, and we're also going to put up barriers to exit. So you can invest here, but you've got to jump through a lot of hoops. And then once you're here, you can't just leave. You know, you've got to stay here. You've got to commit for a long time. And they're hoping that that'll smooth out the fluctuations. Maybe. Who knows? I don't want to commit macroeconomic policy here because it's definitely not my field of expertise, but that's what they're looking at, and that's what they're trying to figure out how to do so they don't fall prey to the same problems that they've seen in the last decade.
And while we're on the subject of India, they've increased their import tax on gold 3 times this year. The tax on gold is now 10%. Is this a type of capital control to prop up the rupee by the Indian government, or is this some form of gold price manipulation by Western banks?
No, it's definitely a capital control on the part of India. Their society, it's a misdirected capital control, by the way, but their society traditionally uses gold as a form of savings. Whenever there's a wedding or anything, the families give gold jewelry to the bride, and that becomes kind of a dowry. That's like the family savings. So in the same way that you might give gold coins to one of your kids, they give gold jewelry to their kids, and they do it on a vast scale because they're a big country. It's 1 billion people. And that was causing them to import a lot of gold and send a lot of rupees out into the world in return for that gold. So it was causing their trade balance to go into deficit, which they thought was making the value of the rupee go down, which in reality it couldn't have been, because for your people to buy a lot of gold is a good thing. You know, your society is putting its capital in sound money, and you're richer for that. So India misunderstood the dynamic, I think, and they're putting up barriers to discourage their people from doing probably the smartest thing that their people could be doing right now, investing in precious metals in a world of fiat currencies. So this won't do them much good, I don't think. No. But it does affect the gold market, because India is a big market for gold, and if their demand drops, then that's less demand in the world for precious metals, and other things being equal, a lower gold price. So that could contribute to what's happening now with the gold capital controls biting in India and causing gold demand to go down just at the time when their festival season starts, and they're normally buying huge amounts of gold. So it could be something that offsets the normal seasonal strength in gold in September and October, and causes it to be lower than it would otherwise. But again, these are squiggles in a long-term bull market that is based on the fact that we're destroying our fiat currencies. So as long as we're making these big, serious macroeconomic monetary mistakes, then precious metals will do okay over the long term. And whether gold goes down $200 an ounce this year and $300 an ounce next year, if it's going to be $5,000 an ounce 5 years from now or 8 years from now or whatever, then it doesn't really much matter. You know, you should just be accumulating a little at a time and expecting it to be much higher at some point in the future. And if you spent, you paid $2,000 an ounce for gold today, and it goes to $1,000 an ounce a year from now, if it's $5,000 an ounce 5 years from now, you still feel smart, even with your $2,000 an ounce gold. And I think that's where a lot of people are going to be. And we won't remember the trauma of the last year once we're all excited by it going from $4,000 to $5,000 in the last spike of the bull market,
So just keep on stacking.
Yeah.
Okay.
Yeah. Cause, you really can't time things.
No.
Bubbles and periods of economic mismanagement, basically any kind of period in your life tends to go on longer than you think it should go. Everything takes longer than you expect. And so all you can do is continue to do the right thing in the expectation that things work out the way they should work out. If you have a good understanding of the situation, then you can live through times when it's not quite the way it should be, because you know that it's eventually going to be the way that it should be. And that's the way it is with precious metals and the dollar and the yen and the euro. We're doing what we're doing. Historically, the results have always been what they're going to be. Therefore, we just need to hang in until things work themselves out.
And speaking of mismanagement, the 10-year Treasury rate almost hit 3% last week. It's almost doubled since May. Is that a knee-jerk reaction from the Fed taper talk, or is the Fed losing control?
Well, it's probably because of the Fed taper talk. The Fed has been buying a lot of Treasury bonds explicitly to force down interest rates. And so if they stop doing that, other things being equal, interest rates will go up. But I think that interest rates would eventually go up anyhow, because if the Fed didn't taper, that means they would continue to pump $85 billion new dollars out into the market, newly printed dollars, forever. And eventually that's going to cause so much new currency to be sloshing around out there that you'll get asset bubbles everywhere, and eventually rising prices across the board instead of just in little niche markets. And that is going to make a 4% 30-year Treasury bond look like a worse and worse deal until nobody in this market is willing to accept a 4% rate for lending money to a profligate government for 30 years. And then rates have to go up dramatically. And so one way or another, we get much higher interest rates going forward. And the question is, does it happen sooner because the government just pulls back and stops printing all this new money? Or does it happen a little later but in a more extreme way, when the government keeps printing money and then totally destabilizes the financial system? So I think either way, bonds are a phenomenal short sale candidate at this point. And again, the next 6 months are completely unpredictable. There's no way to know what would happen if you try to trade in and out of them. But I think if you were short Treasury bonds right now, 5 years from now, you'd feel very smart.
And earlier in the show, you were talking about $1 quadrillion worth of derivatives. Now, I just got my mind wrapped around $1 trillion not too long ago, so now this is a big number.
Yes, it is. Yeah.
And about a third of those are interest rate derivatives, is that correct?
More like 2/3.
2/3.
Which so are basic. They're basically.
Go ahead.
Go ahead. Oh, okay. Interest rate swaps are basically bets on the movement of interest rates. So you've got, if there's 3/4, well, let's say $500 billion right now of interest rate swaps out there. That means half of those are bets that interest rates will go down. And if interest rates spike, that means all of those guys are losing big. And probably a large number of them, like hedge funds and some of the bigger banks, will lose so big that they can't pay their bets off when the time comes. They can't pay what they owe the counterparty on that bet, and they will go bankrupt. And that means that everybody who is expecting to be paid by them isn't going to get paid, and then they can't pay off their bets, and so on. And so you get kind of a cascade failure of the global financial system. If interest rates were to spike, that would be one of the effects of it. And so that's another reason why the Fed has to be incredibly careful, because they can't let interest rates spike too much from here, because already there's a lot of underwater interest rate swaps just from the move that we've seen in the last 3 or 4 months. So let another move like that take place in the next 3 or 4 months, and you've got a lot of hedge funds going out of business. And you've got a lot of big banks being destabilized by their hedge fund customers going out of business. So it's not something that the government wants to deal with, I'm sure.
So that would ripple through the broader markets and just bring the whole system crashing down if they were to move up too fast all at once.
Potentially, yeah. And the thing about, I don't know if you're familiar with Jim Rickard's book, Currency Wars, but if not, great book that explains a lot of this stuff in a unique way. But one of the things he says is that there are different kinds of systems, and there's something called a complex system, of which the financial markets are that of a type, that once they get to a certain level of complexity, they become extremely unstable and very prone to catastrophic failure. And you can't predict exactly when or how it's going to happen, but they tend towards that. And we have created a global financial system that's more complex and more prone to catastrophic failure than anything that has ever existed. So, we can say, well, derivatives might do it, or the Japanese budget deficit might do it, or U.S. interest rates might do it. There's all kinds of things that could destabilize the system, but the system is ready to be destabilized, and something will probably do it. And so it's a question of what and when. And I would argue that those are unknowable things. That's an interesting intellectual exercise, trying to figure out what will be the catalyst and when it'll happen. But really, ultimately, it's unknowable. But when it happens, it'll happen very quickly. So you just want to position yourself as if it's happening tomorrow, and then ride it out. Just be there until it happens, with yourself protected from the probable effects of it. And when it happens, you'll feel like a genius. And until it happens, you'll feel like an idiot. But you have to understand that that's basically the situation that you find yourself in. There is no other way to play something like this. And so that's where precious metals come in. They're, they don't really cost you anything to own. They sit there. They're very compact and easy to protect, easy to store, and eventually they're going to protect you from the craziness that's coming.
So it's kind of like a big Jenga puzzle, and you just don't know which block's going to pull out and bring the whole thing crashing down.
Yeah, and there might be 3 or 4 that you can pull out that would do it.
Right.
And you don't know which, and you don't know which, and you don't know who's going to do it, and you don't know if it's going to happen overnight while you're asleep, and then you wake up in the morning and the financial markets are frozen solid. You don't know that. And you cannot know that. It just can't be known. So all you can do is prepare yourself for the eventuality.
And 312,000 people left the labor force last month. Of the 169,000 new jobs added last month, 123,000 were part-time jobs. What do you expect out of the labor markets going forward?
Well, really, we've been substituting part-time jobs for full-time jobs for a couple of reasons. One is the new healthcare plan that's coming in, where if you're working, I think it's 29 hours a week or something like that, they don't have to give you health insurance. So it's in the interest of a lot of companies to take people who are working 40 hours a week, move them down to 29 hours a week, and save the money that they would have had to spend on benefits. So we end up with a lot of people working part-time, but the government counts that the same as they count a full-time job. So our unemployment numbers are extremely deceptive right now. For instance, if you lose your job today, Mark, and all you can find is McDonald's for $7 an hour, let's say, the government still considers you employed just as if you were a highly paid whatever you are right now. And then if you get disgusted with McDonald's and just give up, stop looking for work completely, the government completely takes you out of their unemployment statistics. So you don't even show up anymore. So they don't count you as unemployed. So that makes the unemployment number look better than it would otherwise. And there are millions of people in that situation where they would like to work, but they've tried to work for a year and nobody will hire them for anything that's worth doing. And so they just give up. And so we've got this society where we've got millions of people working part-time who really want to work full-time, and millions of people who would like to work anywhere and can't get any kind of a job and have just given up. And they don't really show up in the stats. So when they say, unemployment dropped to 7.1% or whatever, that's a very misleading measure of unemployment. If you honestly accounted for it, you'd get something like 12 to 16%, which is depression level. We're like a peripheral Eurozone country in a lot of ways. And we don't know that because the government is in effect lying to us about that and about a lot of other things. But unemployment, I think, is it might not be the biggest one. GDP is pretty big and inflation is pretty big, and they're lying about both of those too. But unemployment is a big one. It's one of those things where if we knew the truth, we'd have a very different sense of our world.
Yeah, I think they said inflation was around 1.7% last year. My coffee went up a lot more than that.
Yeah, and if you're putting kids through college, your main expense went up a lot more than that. Or if you're paying for your own health insurance, get ready for a 40 or 50% increase this year. There are a lot of things that are going up dramatically. And you probably know John Williams over at shadowstats.com, and he calculates inflation and the other economic statistics as if we never made the changes that we've made in those calculations over the past 30 years. In other words, he goes back to the 1970s way of calculating inflation, for instance, and he gets a figure that's close to double digits right now. It's maybe 8 to 10%. And that's if we were using Carter-era inflation calculation techniques. We would have Carter-era inflation right now. You know, it would be looking as bad as it looked in the 1970s. And I doubt if you're old enough to really remember that. But people in their 50s remember the 1970s as being a time of absolute chaos. And we would be like that if we were calculating inflation and unemployment and GDP correctly. So, you know, our country would have negative growth since something like 2008. We'd be in a continuous recession since then. We would have inflation at near double-digit levels, and we would have unemployment at, let's say, 15%. That would be our country if we were calculating these numbers correctly. And we're not. They're lying to us about it. And so most people walk around thinking things are basically okay. Not great, but, you know, inflation is low and unemployment is trending down and the economy's growing, so we must be okay. But really those are statistical lies. And they're being used to fool us into thinking things are much better than they are. That's why most people look at their own situation and think it's a little worse than the overall situation seems to be. You know, like you said, our personal inflation rate feels higher than the government's reported inflation rate. And our job situation is probably tougher and, yada yada, on and on. You know, it just feels harder than the government says it is. And eventually people are going to figure that out. And, that might be the catalyst that causes the bottom to fall out of the economy. When people finally figure out they're being lied to and they just don't trust us anymore, don't trust the big systems anymore, and they start dumping dollars because the dollar is the symbol of the big system. So who knows? But, that's one very real possibility.
And do you recommend that folks relocate to less populated areas if they live in a city? Do you think this is going to be like a zombie apocalypse when everything comes crashing down?
You know, it could be really bad for a while. It also could be over quickly when we just realize that we have the wrong kind of money and switch to something that's backed by something tangible. You know, Weimar Germany had 2 years of epic hyperinflation. We still remember it from the 1920s. But then they switched to a sound currency and it stopped. You know, Weimar Germany in the late 1920s, was not great, but not in chaos anymore like they were in the in the early 1920s. Now, the same thing could happen to us, where we have a couple of really chaotic years, and then we fix the big thing by linking the dollar to gold or whatever, and then things start to get better. In which case, you could live in downtown Los Angeles and probably be okay. But if it goes on for longer, and we allow the systems to kind of spin out of control, and you know, the food supply chain doesn't work quite right anymore, or energy doesn't flow the way it did, then a big crowded city that's a long way from the production of life's necessities would be a stressful place to live. And so if you have a choice, I think the next 10 years, spent in a place that is surrounded by farmland or forests or, water and not super crowded would be safer. You know, it's a better bet. And nothing is guaranteed in life, but I think that, there are a lot of medium-sized towns out there that are close to food production and still have some culture, like there's a college there or something, or there's some interesting technology companies, places like that, where if you have a choice of relocating, it might be worth thinking about, because it would be far less stressful if the worst case scenarios that we've talked about today actually come to pass.
And we've had, it's been a while since we've had really a global meltdown. I mean, we've had, like you said, Weimar Germany and then Argentina in 2001. But, I guess it's since Rome really melted down, since we've had a what you would call a global currency meltdown. And that didn't end too well. There was, I think we call that period the Dark Ages.
Yeah. It took Rome a while to completely destroy their financial system, but their destruction of their financial system coincided with the fall of the empire, and then bad times for 1,000 years. The closest thing we've had in modern times to a global meltdown is the 1930s, and that was pretty bad for a lot of different places. And today we have globalized the financial system. Everybody's making the same mistakes. Japan is borrowing even more money than we are and trying to inflate away their currency even more aggressively than we are. And Europe is a horrendous mess. They've got this stuff called unfunded liabilities, which is what they should have put away today in order to fund their retirement plans in the future. And their unfunded liabilities are hundreds and hundreds of billions of dollars, or excuse me, what are they? I think $100 trillion or something like that for a lot of these guys. They're just astoundingly large numbers. And so they're in worse shape financially than we are as well. But we're in horrendous financial shape. We owe more money than we can ever hope to pay off. And we're dependent on the rest of the world at the same time because trade is so important and we need everybody else in the world to buy our debt. If we can't borrow money from the rest of the world, we have to live within our means, which means we have to cut $6 trillion a year out of our spending if you include unfunded liabilities. It's something we need to cut. And so if the rest of the world can't help us out, we are royally screwed. And so when this comes, when things really start spinning out of control, it's liable to be more global than anything that has happened in living memory. Even people who remember the Depression probably aren't ready for the worst case scenario of the kind of thing that we're creating.
And then in your 2003 book, you predicted the popping of the housing bubble. Where do you see real estate prices in 10 years? And what do you expect between here and there?
Real estate's a tricky one now because it's had a nice run again. Prices are near bubble levels in some of the formerly hot markets that really crashed. And an awful lot of new mortgage debt has been created in the last couple of years. Although a lot of that has been refinancing. So that's not technically new mortgage debt, and it's at lower interest rates, so it actually improved the balance sheets of a lot of people. At the same time, real estate is a leveraged asset, which means that in hard times, people who owe a lot of money on their mortgages end up not being able to pay their mortgages and have to hand the real estate back to the bank. So you get what you got in 2010 all over again. So we could see that. Or on the other hand, real estate could hold up pretty well because it's real. Your house is always your house. It has a certain utility. So if the value of the dollar is going down, then the value of your house in dollar terms might actually go up because your house, isn't going to disappear the way a financial asset might disappear if it depends on dollars. So real estate won't be as terrible an investment as long-term government bonds, for instance. That's what I would be more worried about. If you've got a house and some government bonds and you're trying to decide which one to sell for financial reasons, I would say sell those government bonds, pay off your mortgage, and then just stay in your house. Don't worry about what it's worth. Just know that you've got a roof over your head. And that's one less thing to worry about.
And of course, we'll have a link to purchase The Collapse of the Dollar and How to Profit from It through Amazon in today's show notes. We'll also have a link to your website, but can you tell the folks where they can find you for those who are listening on Stitcher and iTunes and YouTube?
Sure. I run dollarcollapse.com, which is a blog/news aggregation site, which covers a lot of the stuff we talked about here, and it's updated continuously. The idea is you show up for an hour in the morning or an hour in the evening, and you're pretty much up to speed on the dark side of the financial world.
John, thanks so much for coming on the show.
Sure, Mark. Anytime.
Thanks for listening to another edition of the Prepper Recon Podcast. If you're new to prepping and you want to learn more, you can check out our 7-step survival plan. It's under the categories section on the left-hand side of the page. Until next time, happy prepping.